the new Wall Street Week.
Welcome to Wall Street Week, the show of record for long-term investing. I'm Anthony Scaramucci along with Gary Kaminsky. What a difference a week makes. 7 days ago on this show, the main discussion was the UK vote to leave the European Union. The stock market seemed to be on the precipice.
But long-term investors quickly realized that while the United Kingdom did leave the EU, it did not leave the planet. And stocks around the world staged an impressive comeback.
So what's the true long-term impact of the vote to separate from the EU? Today we're joined by the Northwestern Mutual Chairman and CEO, John Schlifske. John, where are we right now, and do you think that the exit of Great Britain is a big deal for investors long-term?
I think it's a harbinger of things to come. So in a way, it is going to realign sort of the commerce in Europe and things like that. But I don't think it's a big deal in terms of investing right now or changing the way you're approaching the marketplace. It's probably going to slow global growth a little bit, put a little pressure on stocks, but I think net it's not going to be a major negative factor on the stock market, and we certainly don't view it as something to be afraid of. So
nothing's changed in your overall asset allocation plan or the way you're thinking about where you want your clients to be?
Certainly nothing's changed on the, from a major perspective asset allocation. I think on the margin, I think we're going to be seeing a little bit slower growth globally. That's probably better for fixed income security. The yield curve has flattened recently, which would argue for lower global growth. So I think on the margin, maybe a little bit more in fixed income and a little bit less in some of the more dicey equities around the world. But net, it's stay the course.
John, I would say that the one thing that was consensus by the end of this week was that interest rates are going to continue to remain low and probably continue to go lower, even some of the negative rates around the world. That has a huge impact on your business. When you joined us last year, we talked about it. A, do you agree that we're basically now going to trend lower here in the United States? And what does that do to your business?
So we are in a low for long period. That's part of our philosophy. I was in Japan in 2009 and talking to a bunch of life insurance companies there, and it made a dramatic impression on me how difficult it was. And so we've moved our business to sort of being able to thrive in this economic environment with low for long. So I think we're well positioned. But I'm of the camp that interest rates are going to stay low for a long time. I was meeting with a couple governors of the Federal Reserve last week, and everybody's talking about 2% growth plus or minus. When you've got 2% growth globally, it's just really hard to see how interest rates can go up.
Well, your assumptions in terms of returns, you've got this huge portfolio premium that you've got to invest in order to run the business. Do you now think from like a year ago that rates are where they are, your total return is going to be low in your portfolio?
We think investors have to adjust for lower total returns over the near and medium term. There's no doubt about it. The notion that equities are going to be up 7 to 10% a year and you're going to get 5 to 6% on bonds, I think, are out the window. And I think people have not fully adjusted for that, but portfolio returns aren't going to be the way they are.
But John, 2% growth is it creates a lot of financial anxiety. You've got low income, low wages, low increases in wages. Is there anything that we can do to make the individual investor less financially anxious?
So there's a lot we can do, and that's what our company's all about, is figuring that out. We've done some studies and have found that 85% of Americans are worried about their financial security. 25% of them worry about it on a day-to-day basis, and over half of Americans don't even know where to go. And the problem exists because I think historically the markets have done so well. People think all you need to do is put some money in your 401k, it'll go up and you're fine. But an invest-only approach to financial security isn't enough. And what we're telling people is you have to integrate your insurance and your investments around a plan in order to be totally financially secure. And you can't expect the markets to bail you out of bad decisions.
Let's go back to insurance as a product, because we did talk about that as well. And I think we got tremendous feedback last year. People saying, I think about stocks, I think about bonds, I think about real estate. I don't think about insurance as an investment. How do you think about insurance as an investment?
Whole life insurance has several features that really augment a portfolio. In some ways, it's like your mobile phone. You use your mobile phone now not just to make phone calls, but for all sorts of things. And that's sort of what your whole life insurance can do. First of all, it has cash value that grows on a guaranteed basis each and every year. So that's a huge impact.
It's tax deferred as well.
And it's tax deferred as well. So that cash value is growing on a tax deferred basis year after year, guaranteed. Second of all, what it does is it gives you access to liquidity, especially in down markets. So if you did need cash over the last few days when the market was down, you could access that without having to sell securities at a loss or things like that. But the biggest thing really, I think, is that it gives you an ability as you near retirement to almost construct your own defined benefit plan. It gives you the ability to create income for life and in a way that's very safe and secure. And ultimately what it does to a portfolio is it reduces the volatility and increases your overall performance in the long run.
Yeah. Do you think there's a recession on the horizon given everything that's going on?
I'm actually, we don't think there's a recession. We're sort of modestly optimistic about the economy going forward. As I said, I think it's going to be low growth. But there's so many good things going on in America right now. You've got the demographics of our country. We've got a young population emerging. In fact, a fun fact I just saw yesterday, 5 years ago, age 50 was the #1 age in the United States. Now, the top 5 #1 ages are under 30, all 20-something-year-olds. So we've got this millennial boomers, millennial generation that's moving into the consuming phase, and that's going to help our economy. We're almost energy independent. We're an entrepreneurial, innovative society, so I think we're in a good position.
How about the people like Gary that still think they're millennials? Do you think they're helping?
Well, I was going to just say that demographic fact is kind of depressing for the three of us.
Yes,
but I kind of, you know,
yeah.
it tells you what's happening in the world.
We moved out of the top 10 is all I can tell you. Right,
all right,
yeah.
John, stick around. We'll be right back, folks.
Okay.